Wall Street closed out the session on choppy waters. John Terrett has this from the New York Stock Exchange.
After the closing bell on Wednesday on Wall Street, KB Home gave us their latest set of earnings. They beat Wall Street expectations, and as a result, their shares were sharply up in the grey market. But the big story of the day on Wednesday on Wall Street was the Federal Trade Commission suing Amazon over its enrollment practices for Amazon Prime. In other words, its subscriptions. Now, this gets pretty nasty. The FTC is saying basically that Amazon tricked its customers to signing up for Prime and then wouldn't let them go. Made it very, very difficult for them to unsign up. Now, the FTC says that Amazon is guilty of manipulation, coercive or deceptive behavior. And of course, Prime is not cheap. It's about $140 a year, 15 bucks a month. Amazon responds by saying, look, the FTC is misinterpreting the law and everything they've said is false. And I do have to say that it is true that all of these companies, all of them, from the cable company to the phone company, name a company where you need to subscribe online, they all make it very difficult for you to end that particular contract. So we'll see how this case goes. Amazon shares down almost 1% on the Wednesday session, but they're up 32% since COVID broke out, and almost 0.5% in just 2023 alone. On the main markets, Chairman Powell testifying before the House Financial Services Committee, warning of more interest rate hikes, rather rattled things. The Dow was down 1/3 of 1%, the Nasdaq by 1%, the S&P 500 by 0.5%. 5 out of 11 S&P sectors in the red. Bitcoin had a good Wednesday, up 7% above 30,000. On Thursday, earnings from Accenture, BlackBerry, Smith & Wesson. We get the weekly jobless numbers. Chairman Powell moves on to the Senate. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more on the Federal Reserve or trying to understand what they're doing in the U.S. economy, Ken Kuttner, economics professor, Williams College. Good to see you. Thank you. So I could not be, I guess, frustrated or confused, because it seems to me the chairman there wants everyone to think that rates are going to keep going up, even though Wall Street, I guess, is sort of testing his patience on that. We had the pause, but then we had the we may hike a couple times later. What's going on here?
Well, you know, I don't think Powell could have been any clearer on that. I interpreted his testimony as being quite explicit about saying that people should be expecting at least one more rate hike, maybe two. And as he stressed during the testimony, it's really just the pause was not an end to rate hikes. It was just a slowing down of the pace of rate hikes. I thought that was a really notable takeaway.
Well, one of the things that I guess was impressed upon me, I watched part of the testimony, is the obsession with the inflation being at 2%. And in an economy that's bouncing back from COVID, I know we got world problems, but the economy is actually quite strong. And that's the problem, as it's quite strong. People are traveling, people are spending. You look at different industries, jobs are still being created. We're at near an all-time low in terms of the jobless rate. What's wrong with having inflation at 2.5% or 3%? Why does it have to be 2%?
Well, nothing really magical about 2 per se, but the Fed has spent so long emphasizing the 2% target that I think there's a concern that to back off from that and say, hey, you know, it's all right, we're okay with 2.5 or 3. The Fed is really concerned about losing its credibility and going back to the bad old days in the 1970s when inflation expectations were not anchored.
Right, but we're talking about a time when we're talking about double-digit inflations or high single digits. We're talking about the difference between 2 and 3%, and we're causing enormous consternation in the capital markets, enormous consternation in the real world when it doesn't have to be. I don't think there's a huge difference between 2% and 3%. If it means we have growth in this country and have 3% inflation versus throwing everything into chaos and having a recession just to get to 2%, it doesn't seem like it's a realistic target to me.
Well, if it did, in fact, involve throwing everything into chaos and causing a large recession, then yes, that would, of course, be that would be undesirable. But I think I think the Fed stands a very good chance of being able to get it down to 2% gradually, with relatively low cost.
For Americans, we often talk about, you know, as we go into a presidential election cycle, everyone's going to ask the same questions, which is, you know, are you better off today than you were X number of years ago. And when we look at the inflation data, yes, things are costing more money, but the lives of Americans today, for many of them that is, are fairly decent, right? There is a roof over your head. Most people have transportation, or at least some transportation. And then you look at the job issue, which we don't have a high jobless rate. These are some things that I think both parties are going to take credit for, and on the negatives, both sides are going to blame each other. Where are we on the true cost of living today versus, say, pre-pandemic?
Well, it's hard to say. The one thing I would point out, you make some very good points, which is that the employment is very high. Unemployment came down after the pandemic much more rapidly than I and many of the people expected, and the unemployment rate is back down at 4%, which is pretty astonishing. However, if you look at the data, the wage growth has accelerated, but wages have not kept pace with inflation. So a big swath of the population is in fact experiencing reductions in real wages, and that's hurting a lot of people. And I think the chairman was right to emphasize that a lot of people, even in this high employment environment, are really feeling some pain from the acceleration in inflation.
The chairman was asked about the timing from one of the folks in his testimony, and it had to deal with this pause, this one-time pause. In other words, why pause now? And the reason the chairman gave was that the pause was to let the other rate hikes, I guess, flow through the system. If that's the case, the experts that we've spoken to and the economists says, okay, it takes between 6 months and 12 months for things to flow through the system before you see an actual impact to the economy. If such, then there shouldn't be a rate hike anytime in the near future because we're waiting for everything to flow through. How should we interpret that?
Well, actually, I would pitch the other way. I think the Fed has been raising rates since for over a year now. Typically, at least in the research I've done, one sees that rate hikes start to impact the economy, the real side of the economy, things like employment and industrial production, after maybe 6 to 12 months. And so, to my mind, it's a little bit surprising that the rate hikes we've seen so far have not really had a measurable impact on slowing the economy so far. And I think that's causing me to shake my head a little bit. The effects on inflation tend to be much more gradual. So I think the Fed can't really afford to wait for the full 1 to 2 years to see the impact on inflation. But the first thing it's going to be looking for is have we slowed the economy down to a more sustainable rate? And I think it's made some progress there, and that bodes well for inflation. But I think the Fed senses that it's not quite clear that we're at a sustainable pace of economic activity.
Yeah, I mean, I guess the messaging has been relatively clear, but I guess us as investors and regular folks, we're trying to plan out our lives for the next couple of years. And I guess we just don't have the answer to that. We'll see what the unintended consequences of all this are going to be. Professor, good to see you. Thank you for helping us analyze this.
Yeah, you're welcome. Pleasure to be with you.
Okay, appreciate it.